Welcome to Money News. I'm Kathleen Walter. With us today is a very special guest, Mr. Jim Rogers, chairman of Rogers Holdings and author of Street Smarts, Adventures on the Road and in the Markets. And Jim, welcome back to Money News.
I am delighted to be here, Kathleen. Nice to see you.
Jim, you have an amazing track record of predicting where the economy is going. Let's start with the U.S. economy. On the one hand, signs point to a burgeoning recovery. Unemployment is down. The housing market seems to be rebounding somewhat. First quarter GDP is up. But yet other signs, such as household savings, industrial production, and so on, suggest that the economy might be contracting. What is your take?
Well, Kathleen, right now we have a very artificial situation. You have the central bank in America printing staggering amounts of money. You have every central bank in the world major central bank printing money at the same time. This has never happened in recorded history, Kathleen. So there's this gigantic artificial flow of money floating into our economy and others. And unfortunately, this is going to end badly when it ends because it is artificial. You point out, you can see signs that things aren't right. Well, they're not right. The only thing that's right now is they're printing trillions of dollars. Kathleen, you give me $1 trillion, I'll show you a very good time. My goodness, I'll show you a good time. And the people who are getting the money are having fun. I'm not so sure about the rest of the world.
Federal Reserve officials indicated that they might slow down quantitative easing sometime in mid-2013. The Fed has been on a spree, spending $85 billion a year investing in treasuries and mortgage-backed securities. How long do you think this will go on for, Jim? And what do you see happening when the Fed finally begins to pull back the punch bowl?
Well, Mr. Bernanke has said it's going to go until 2015. What we're understanding now is that there are some people at the Federal Reserve who are not happy about all this staggering amounts of money printing because they know it's going to have bad consequences. It seems that Mr. Bernanke may be leaving in a few months. I guess he wants to get out before he has to deal with the hangover, with the aftermath. I don't know how long it will last, Kathleen. I don't see how it can last much beyond this year. But if Mr. Bernanke stays, he's determined to do it. The Japanese are determined to do it. The English are. The Europeans are. What's going to happen is either eventually the market's just going to say, stop, we won't take this anymore, and bonds will go down despite the central banks, or the public, us, are going to say, wait a minute, we don't want this paper money anymore. It's too absurd, and prices will go higher, and you'll have more and more unrest in the world. Mm-hmm. So something's going to force it. I would suspect it will be forced by the end of this year. Bernanke says he can keep it up till 2015, and so do the Japanese.
The stock market continues to hit new highs despite a lot of economic uncertainty. What is driving the new highs, and do you think that stocks will continue to climb, or are we headed for, a huge plummet here?
Well, I don't think we're headed for a huge plummet anytime soon, unless somehow the money printing stops. No, stocks are going to go up as long as they continue to print all this money. Again, it's artificial. It's extremely artificial. But, the United States stock market is up 10 days in a row. That is extremely unusual that the markets go up 10 days in a row. I mean, this is back to the late 90s when we had our last bubble. Stocks always going up. That's not healthy.
Jim, Harvard professor Martin Feldstein has stated that at some point interest rates have to go up, and when they do, there will be downward pressure on stocks and the economy will begin contracting again. Do you agree with that statement?
Oh, absolutely. So interest rates certainly have to go up. I mean, interest rates have been going down for 32 years, which is very unusual. So we've had a long bull market in bonds, or declining interest rates. No, that's going to change. The interest rates right now are artificially low. It cannot last. They will go back to a proper level eventually. There are people will tell you that the bond bull market is finished right now. The bonds are now going to be going down. Our interest rates are going to be going higher. I don't know if it's happening this month or not, but certainly know it's going to happen in the next year or so, if it hasn't already happened. And then interest rates will go higher. Governments around the world have huge debts. They're going to have massive funding problems when interest rates go back to normal.
Is the bond market headed for a big meltdown?
Not this month, I don't think, but yes, it's certainly going to go back into a bull market. And the thing about bond markets, Kathleen, and we usually have very long bull markets in bonds and long bear markets. This bull market, as I said, has lasted 32 years. Well, the bear market before that lasted 35 years. So you can see that the cycles are very long. So once interest rates start going up or bonds start going down, it's going to go on for a long time, and it's going to be extremely painful for a lot of people.
What about the world economy, Jim? We're getting mixed signals here as well, with the Eurozone economy shrinking for a record 6th consecutive quarter in the first 3 months of the year. France is in recession. What is your outlook here, and will the Eurozone survive?
Not as we know it. Well, first of all, I hope the euro survives. We need something to compete with the U.S. dollar, which is a terribly flawed currency now. I don't see how the euro can survive as we know it, though. You know, they got a lot of mistakes in there. They've made a lot of mistakes. And, of course, this whole concept that Brussels can control everything. Nobody in Brussels very few people in Brussels are even elected. So you've got this massive bureaucracy in Brussels controlling all the nations of the European Union, and the people are getting very unhappy about it. So the euro as we know it will not survive. I hope something survives to compete with the U.S. dollar.
Since we last spoke, the price of gold has plunged. What do you think really was behind that sell-off, and are you buying more gold these days?
Well, it's what we discussed before. You know, that gold has had this remarkable 12-year period where it never even had a down year, which is extremely rare. And so, to my mind, when something goes down, people come up with all sorts of reasons in hindsight. My main view is that it was well overdue. You don't go up 12 years in a row without a down year. It's not the way markets work. So now it's having a long overdue and much needed correction that could last, I don't know, several days, weeks, months more. And it's good for the gold market because gold needs to make a correction, find a new base, a new bottom, and then the bull market can continue.
Jim, Japan just okayed a $906 billion budget. How much do we need to worry about the Japanese yen's weakening past 100 per dollar, the weakest level in over 4.5 years? And is a global currency war inevitable?
A global currency war is in process. The Japanese yen has collapsed 27% in 6 months. That is astonishing that one of the world's major currencies has collapsed that much. That's usually leading to some kind of problem somewhere. Somebody's on the wrong side of that trade, Kathleen. It's already causing trade problems with the Koreans and the Chinese and the Germans. You know, a lot of people are already waking up and saying, wait a minute, what's going on here? So no, we're going to have more currency turmoil and more currency problems. Be careful. Be very careful. And as you said, the U.S. dollar is a terribly flawed currency. I own it. I don't own it because I have any confidence in it. I own it because other people will flee to the dollar in times of turmoil.
All right, Jim Rogers, thanks so much for being with us and for sharing with us all your insight.
My pleasure, Kathleen. Let's do it again sometime.
I look forward to it. And thank you for watching Money News.